G'day guys, welcome to the channel. My name's Tim, and on today's episode, we're taking a look at where we are in the current Bitcoin cycle and how it compares to previous cycles, namely 2013 and 2017. Now, there are a lot of theories about what causes the Bitcoin cycles. We have the stock to flow model, we've got the Bitcoin halvings, which I've got listed here on the screen at the moment. We've got Wyckoff distribution and accumulation methods. We've got supercycle theories. And the truth is, we don't really have enough data at this stage to categorically say which theory or model is most accurate or most correct. But looking at the data, I've actually come up with what I believe is another model that explains what causes Bitcoin to surge and what causes the altcoins to surge. So for those new to the channel, what I've got on the screen here is 10 years worth of Bitcoin wrapping around. So from September 2011 to August 2015, we've got the 2013-2014 cycle. And then from August 2015, we start back down here again and go to December 2018, which was the 2017-2018 cycle. And then from December 2018, we start here at the 2021 Bitcoin cycle. Now, the reason I've chosen these dates and not the halving or anything else is because I've noticed a pattern with Bitcoin and the stock markets. And I'll bring up right now the Dow Jones. So this is 100 years worth of the Dow Jones. This is the 1929 crash. This is the 1960s. We had the 1980s here. That's the dot-com bubble era. This is the great financial crisis. And now this is the last 10 years of where Bitcoin has existed. So I'm going to zoom right into the last 10 years. So we can see September 2011, this is the date here, and you can see there was a dip, and we dipped down to the 2.5-year moving average. And then in August 2015, we also did a dip, and then December 2018, we did a dip, and then we did another one, which was the COVID crash, which I still believe was a black swan event. And if it wasn't for COVID, we probably would not have gone down that far. And now this is where we are at the moment. Now, these particular dates don't just appear on the Dow Jones, but they also appear on other stock markets. So here we have the Hang Seng Index, which is China in this kind of light blue color. Here's the Dow Jones in blue, which we've just been looking at. We've got the All Ords, which is Australia, and the S&P 500, which is America. So you can see they all tend to dip at these same times. So going back to the Dow Jones, I've noticed that Bitcoin always peaks right in the middle of these cadences. So right here, that was Bitcoin. And right now, starting from December 2018, Bitcoin peaked here. So it's always right in the middle, right in this risk-on area of the overall markets. So you can see the markets always start off with a bit of a rocky start, and then they get into their groove. Rocky start, into the groove. Rocky start, into their groove. So when they're in the groove, that's when Bitcoin is peaking. So that's why I've chosen these particular dates, September 2011, August 2015, and December 2018. And this is what it looks like when you line up the 3 Bitcoin cycles starting from those dates. You'll notice that the peaks all occur in the middle of this 4-year cadence, just like that. They're all in this middle section right here. And if you look at 2017 and 2021, the peaks have occurred basically at the same time, and the 2013 peak was a little bit sooner. Now, if I measure from those macro market correction dates, you can see that we're the 2017 and 2021 peaks were about 2.3 years in, and the 2013 peak was about 2 years in. So we're right in the middle of those 4-year cadences. So already we're seeing some similarities with the 3 cycles all peaking at around about the same time in relation to the macro markets. But another thing we also notice is that the 50-week moving average, which we've bounced off here in the 2021 cycle, this light blue line, it has occurred right here at this point in the cycle, right after the peak. We then bounce off it and go back up. So in 2013, you can see right here, this is the point where we bounced off the 50-week moving average, this little spike. So if we look back here, that's this spike just here. So the 50-week moving average went up like that. Now in 2017, we did something similar, and it was right at this particular point here, we did a double bottom. So let's go to 2017, 2018. You can see here, so there was a little spike down there, which we did a V-shaped recovery out of, but we ended up hitting the 50-week moving average right here at the double bottom. So I'll draw that in. So as you can see, the cycles are now also appearing very similar. We peaked at a similar time from the macro market corrections, and we've bounced off the 50-week moving average at a similar point in all three cycles. And in terms of the percentage increase bouncing off these 50-week moving averages, we're in a similar ballpark. So if we measure from here to here, we get actually 96%. If you go from the spike, if you go from where it sort of flattened out, you get something like 60%. And in 2017, you get something like 54%. And down here, we're about 65%. So somewhere in that, you can say that 60%, 54%, 65%. It's a similar bounce. So the next thing you might notice is that the 2013-2015 cycle finished way out here, whereas the 2017 and 2018 cycle finished here. So does that mean we're going to finish here next time? Well, I don't think it's quite as simple as that. If we go back to the Dow Jones, you'll notice that the distance between here and here was exactly 4 years. But the distance between here and here was 3.3 years. Now, these macro market cadences are on average every 4 years if you look throughout history. If I zoom out here, you can see these bounces happen approximately every 4 years. But they're not exactly 4 years. So you might have 3.3, you might have 2 years, and another 2 years like we did down here. You might have a longer period here, might be 5 years. So it's not exactly predictable whether it was going to be a 4-year cycle or a 3.3 or a 5-year cycle. So we don't really know. So that's why I don't believe that we're actually having lengthening cycles. I think that Bitcoin is dependent on what happens with the macro markets in general. So in the 2013-2014 cycle, the macro markets look something like this. And then in the 2017-2018 cycle, it looks something like this. So it really matters what happens next with the 2021 cycle and whether the macro markets correct sooner or later. So in terms of the overall economy, there are a couple things to keep an eye on at the moment. The jobs data was released on Friday, and as you can see from some of these news headlines, it was disappointing. So there were expectations of 720,000 jobs, but there were only 235,000 jobs added. And you can see that over a couple of these headlines. Also, the Hang Seng Index, which is China, is also showing some signs of going down at the moment. And we can see that in the past, what I've got on the screen here is the S&P 500 in blue and the Hang Seng in purple. You can see that they generally do correlate. So when they both go up, they both go up. They both go down together. This is a point here where the Hang Seng went right up and the Dow Jones only went up a little bit. This is around the financial crisis era. They both dipped at the same time. They both dipped at the same time here. They both go up at the same time. They both dipped for COVID. So right now, China is going down, it appears, whereas the S&P 500 America is going up. So that's something to keep on your radar. The Fed has talked about tapering their asset purchases later this year. But will that happen now that we've got the jobs data that's just come out? Like we don't know. So we just need to keep an eye on these macro indicators to give us a bit of an idea of when the macro markets may have their next correction. Now, they do correct. Every 3 to 4 years on average, they do correct. There's never been a time when the macro markets haven't corrected. So we will see that again. This time won't be any different. And when those macro markets do correct, that'll probably line up with when Bitcoin tends to bottom. Okay, so I've just got rid of some of the green lines so we can see this in a bit more detail. So right now, we've bounced off the 50-week. We're up here trying to work out what we do next. Now, as you can see in the previous cycles, it wasn't a case of just simply crashing down all of a sudden. You can see that it was a long, drawn-out process. We do these big bounces until we end up bottoming out. And a similar thing happened here in 2017. We bounced up, down. Now, these take months and months to occur. We shouldn't really expect there to be some sort of flash crash out of nowhere. And if there is a flash crash, then it's most likely going to bounce back to where it was anyway. We don't really know what will happen next, but the volume is not there at the moment. We're struggling to push past 50K. We're following a very similar pattern to what we have in the past at a very similar point. There are signs of a weakening economy, which to me makes me think that risk on assets, shouldn't really be surging at the moment, but anything can still happen with crypto, as we know. So anyway, that's all for today's video. I hope you enjoyed that. Just a few things to keep an eye on in the macro markets as well as the Bitcoin charts. I hope you enjoyed the video. My name's Tim. Please follow me on Twitter at TechnicalTimCR1. Thank you so much for the comments. I really appreciate all the wonderful comments and people getting involved in the discussions. So until next time, I'm Tim, and cheers. I need a bit more energy. I want to... hello, everyone. Welcome to my channel. G'day, everyone. G'day, guys. Let's get some energy. Tim! Woo! Let's go! Woo! Sorry, that was a bit over the top.